Welcome to vTalkInsight, Market Drivers Daily for June 30th, 2026. AI investment is no longer just a tech story. It is now colliding with geopolitics and central bank policy, and that collision is driving how equities, credit, and rates are priced. Let us start with how the AI Capex Supercycle is reshaping the growth and risk backdrop. The core story now is that AI has shifted from a narrative about future promise to a concrete capital expenditure cycle that is visible in hard data. Hyperscaler technology firms are driving a massive build out of AI infrastructure, with projections for investment running into the multi-trillion-dollar range by 2030 and updated estimates already sitting well above earlier consensus for the next few years. Earlier in the week, we talked about Korean memory and data center plans and Micron's earnings as early proof points. Today, the Capex wave looks even more entrenched and systemically important. The investment focus is moving down the stack toward the bottlenecks that actually constrain deployment. Chips, high-density data centers, power, cooling, memory, and even industrial metals like copper are increasingly being treated as strategic assets in the AI build-out. Semiconductor and memory stocks are having their strongest start to a year in 6 years. Equal weight technology is outpacing the mega caps, and rail traffic in the United States has picked up as data center construction pulls more goods through the system. At the same time, hyperscalers carry large backlogs and are issuing record volumes of investment-grade debt to fund this build. Yet spreads remain tight and balance sheets are still described as robust. This Capex surge is already visible in macro aggregates. Recent estimates suggest AI-related spending is contributing roughly half of the current 2% United States growth rate, and structural productivity gains from AI could add as much as half a percentage point to trend GDP over time. Corporate Capex plans globally remain firm, with energy security, defense, and AI all cited as priorities, and that mix supports a sustained trend rate of global growth. But this is not a free lunch for inflation. Rising demand for chips, memory, and energy is being flagged as one factor behind sticky price pressures, complicating the outlook for central banks that were hoping falling oil alone would do the heavy lifting. Against that powerful growth impulse, there's a growing list of risks. There are clear valuation questions, with projections for $1.2 trillion of AI capex by 2028 already sitting well above earlier forecasts, and markets debating whether earnings will arrive quickly enough to justify current multiples. There is also a disconnect between skepticism on hyperscaler returns and very strong demand for chip suppliers, which could create scope for future Capex pullbacks if economics disappoint. On top of that, AI models are becoming commoditized, shifting value toward proprietary data and enterprise integration, just as regulators in the United States restrict some domestic models, while Chinese systems undercut on price and capability in areas like cyber. Boards are demanding clear returns on AI projects. Sectors like call centers are already facing disruption and earnings downgrades, and the IMF is warning that AI-enabled cyber attacks are a growing risk to financial stability. Key signals to watch now are hyperscaler Capex guidance, July earnings commentary from the broader S&P 493 on realized AI returns, and any shift in credit markets' willingness to absorb further tech issuance, because those will tell you whether this supercycle is still in expansion mode. These choices on where and how to fund AI do not sit in isolation. They're increasingly entangled with geopolitics and energy security. Geopolitical risk remains elevated, but markets are selectively fading it, especially in energy. In the Strait of Hormuz, Iran has tightened its effective control and even floated the idea of imposing tolls on shipping. Yet commercial flows have proven surprisingly resilient, with dozens of vessels and millions of barrels still transiting the choke point. Temporary sanctions waivers have allowed more Iranian crude into the market, and oil prices have stabilized in the low 70s per barrel after falling back from around 100, even as negotiations between the United States and Iran in Doha have produced only a vague memorandum so far. This uneasy balance carries important medium-term consequences. Shipping routes are more complex and costly. Insurers and ship owners remain cautious, and normal pre-war tanker flows have yet to be fully restored, even as some banks project the risk of a supply glut if flows return too quickly. Gulf allies are openly questioning how far they can rely on American security guarantees. The traditional Sunni-Shia divide is becoming a less reliable guide to alliances and economic sanctions are proving less decisive as targeted countries develop workarounds. Europe, in particular, remains more vulnerable than the United States to any renewed energy shock, which keeps a premium on investment in energy independence and low-carbon baseload power. Beyond hydrocarbons, geopolitics is driving a structural shift in where capital is deployed. European defense manufacturers are expanding capacity to meet record missile and drone demand. Defense names are outperforming on the back of large order books, and the United Kingdom is pledging more on defense, even if headline increases still lag stated targets. Fiscal resources are being redirected into security, infrastructure, and energy transition, and there is active discussion of new financing tools such as defense-themed bonds. At the same time, U.S.-China friction continues to reshape technology supply chains, from Taiwanese raids linked to alleged chip smuggling, to American lawmakers launching security probes into China-related pharmaceutical trials, to Washington adopting more explicit industrial policy in AI and other strategic sectors. The dollar retains its dominance in global transactions, but moments of stress are seeing more use of alternative currencies, which some see as an early sign of long-term de-dollarization risk. For the moment, risk assets are not pricing these tensions especially aggressively. Global equities are on track for their strongest quarter in nearly 6 years, largely powered by technology and AI beneficiaries, and recent earnings from consumer names, such as a major UK grocer show demand holding up despite war-related headlines. Oil prices have declined even as tensions between Israel and Hezbollah simmer, and as shipping disruptions in Hormuz generate sporadic skirmishes, suggesting traders are leaning heavily on the evidence of resilient flows. The risk, as we discussed in previous days, is that another genuine disruption in the Gulf or a breakdown in U.S.-Iran talks could see bonds and equities sell off together, particularly in Europe, where energy sensitivity is highest. Key watch points here are any change in sanctions waivers for Iranian crude, fresh incidents in Hormuz, signs of escalation between Israel and its northern border, and further shifts in defense or industrial policy, because all of these have the potential to reprice both energy and risk premia quickly. Those same shocks would feed directly into how central banks think about the next leg of the tightening cycle. Monetary policy is now in a finely balanced phase, where central banks emphasize flexibility and data dependency, but markets still see a meaningful chance of further tightening. In the United States, front-end Treasury yields have risen around 30 basis points over the past quarter. The curve remains inverted, and markets are pricing the risk that strong growth and inflation could eventually force additional hikes, even if the base case is for rates to stay on hold this year. Low long-term break-even inflation rates suggest investors still trust the Federal Reserve's commitment to price stability, but recent hawkish rhetoric and upcoming labor data are keeping a lid on expectations for cuts. On the growth and inflation side, the same AI-driven Capex that is supporting earnings is also complicating the Fed's job. Strong services employment, especially in leisure, hospitality, and transport, combined with robust capital expenditure in energy security, defense, and AI, points to persistent wage and price pressures. Recent commentary notes that sticky inflation linked to components such as memory and chips reduces scope for early rate cuts, and some analysts expect growth and inflation to re-accelerate enough to bring rate hike discussions back next year. This backdrop has strengthened the U.S. dollar, pressuring Asian currencies like the yen and Korean won, encouraging overseas investors to trim Korean equity exposure, and prompting warnings from banks that an extended dollar rally could become a significant paying trade in the second half. In Europe, the European Central Bank is wrestling with its own version of this dilemma. After a quarter-point hike in June, officials, including the president, have stressed that the move was a data-driven response to previously high oil prices rather than a symbolic insurance hike, and they are deliberately avoiding rigid forward guidance. Market-implied probabilities still assign roughly two-thirds odds to another ECB hike in September, but falling oil prices and evidence of disinflation have reduced the urgency compared with expectations earlier in the summer. At the same time, inflation is projected to stay above target for several quarters. Second-round effects in wages, food, and services remain a concern, and policymakers openly note that they may prefer to move promptly if the data deteriorate rather than risk falling behind. Elsewhere, the Bank of England has effectively tightened conditions by seeing this year's rate cuts priced out, raising mortgage costs by around 60 to 70 basis points, while Japan's bond market is flashing uncertainty as long-term yields rise and short rates fall, calling into question how far its central bank can go on tightening. Across regions, the common thread is uncertainty about the end point of this tightening cycle and about political constraints around central banks. Recent legal developments confirm that central bank independence is not completely insulated from political challenge, which in a tail scenario could undermine confidence in inflation control and raise term premia. For now, though, some measures of financial conditions already show substantial tightening. Household inflation expectations remain anchored, and there is a growing case inside the Fed and ECB to pause and assess how prior hikes are transmitting into the real economy. Markets expect the United States 10-year yield to trade in a relatively contained range that already reflects one or two additional hikes, and institutional demand for long-duration bonds remains solid. Emerging markets, meanwhile, have weathered unprecedented Fed hikes and recent oil shocks better than in past cycles, thanks to faster adaptation in energy sourcing and supply chains. The key things to monitor from here are the upcoming ADP data and jobs report, wage and services inflation prints, further guidance from the ECB on second-round effects, and any signs that AI-related Capex is either sustaining or fading. Together, those signals will determine whether higher for longer remains a gentle plateau or returns to a steeper hiking path. To wrap up, the AI Capex Supercycle is now a core macro force, boosting growth and earnings while also pushing up against physical, financial, and regulatory constraints. Geopolitical tension, especially around the Strait of Hormuz and U.S.-China technology competition, is quietly reshaping energy security, defense spending, and supply chains, even as headline markets mostly look through the noise. Central banks are trying to navigate this mix with a data-dependent, higher-for-longer stance, balancing disinflation from lower oil against sticky pressures from wages and AI-related input costs. How these three forces interact will drive the next leg in equities, credit spreads, FX, and yield curves, so watching Capex guidance, energy flows, and labor data together will be critical. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.